Good morning and welcome to the live session. My name is Josip Kasik. This is Options with Options. Please take a moment to read the disclaimer. We want to make sure that welcome to the live session. We want to make sure that you know where to contact us. So the email address is right here. If you want to get in touch with me, at the end of each session, I post my notes on our website. So I'm bringing the website right here. Here is the trading with the unfilled order slash Josip. When you scroll it down here, you have a live session notes. These are the notes from the last trade that we placed on Valero. And after you're done reading the disclaimer, I'm going to show you where the market is and what we're going to do next. So I have created the agenda and I have a Word document that I would like to share with you on which I'm going to be putting the notes about everything that we are doing. So if you can type in the chat box that everything is fine, that you hear me, I would really appreciate it. So we're going to look at the big picture, and then after that we're going to look at sectors and we're going to place some trades. So without any hesitation, I'm going to now look at the market. So we have a interesting situation that market has rallied quite a bit over the last two sessions, and today is pulling down. Good to see you, Jeff. Good to see you, Mark. I appreciate you giving me feedback. Let me just quickly show you on the FinViz where the market is right now. So this is a FinViz website, which is a free website, and each of these bars is a 10-minute bar. And right now, Dow Jones has filled the gap, and it's a little bit gapping. Not gapping. It's bouncing after it has filled the gap. Nasdaq is at its low, and S&P is slowing down. So when I look at the bigger picture of the SPY, starting from the left to the right, we can observe that we came very close to touching the 9-day exponential moving average. And then today we gapped down, and currently we are now going lower. And we also have a higher activity on the puts than on the calls. So knowing that we have a higher activity on the puts and the call, our bias should be to the bearish side. So having said that, I would like to point out to you that what we can do is keep on looking at most underutilized tab on our website, which is groups. And when I click on the groups, you would see that we have ability to click right here on where it says a trend and show a little bit more than seeing the sea of the redness. And if I click here check mark on the long trend, we are getting the lower studies on each of these things, and these lower studies are showing a little bit more than what is being shown earlier, which is only the 10 days of the activity. So the top part shows the 10 days of the activity. As you can see all across the board, entire market is down over the last several sessions, and us putting the check mark for long term, we are finding that, for instance, utilities are the sectors that are actually overall is still looking good, and we can consider placing some trades on it. So if I now pull up the XLU, which is a ticker that tracks the utilities, and I switch it to the weekly, which is a bigger time frame, you would see that overall the trend on the utilities is to the upside. So we have a low, and we have another higher low, and we have another higher low. And when I look at over here in the terms of the highs, we have a high and another high and another high and another higher high. So this is a sign of the uptrend. So one more time, under the groups, we're adding the long-term trend, and then we're looking up what is going up. So what we did the last time, we actually found a trade on the NRG, which was one of the sectors that was up, and one of the stocks that was up. And I was also working on finding out another example of something that is good, such as Valero. So knowing these things, I want to proceed in the same way, and simply look for the most important thing that we can look at. So in utilities, I'm going to just share this with you. In utilities, I have found about three different things that I really like the way how they look. So for instance, over here, when you look at it, I have found a VST, that's a Vista Corporation. It's a $25 stock, and the way how it looks is that on a longer term it's up, and it's also on a shorter term it's up. And this is one of the electric utilities. So one of the electric utilities that we're going to look at is VST. It's a $25 stock. Then I have looked at another one, which is a Vex Energy. Longer term it's up. Currently it's setting up quite sideways. And the last candidate is going to be XLE. That's a $74 stock. So I'm going to now show you how to actually find this when we are going through these things piece by piece. So what we're going to do now, we're going to scroll it down here where it says utilities. We're going to double click on it, and we're going to observe that this thing is broken down in three different, what I like to call the subgroups. So you have electric, you have a multi, and then you have a water. Now, within each of them, there is a bunch of choices. So I'm double clicking on the electric one. And as you can see over here, I'm getting a lot of choices. So I have gone through these choices, and I have selected these three that I was just showing to you. So VST was one of the candidates that I found that was very attractive, and I really wanted to look at these last three right here. I'm going to put the rectangle around it so it will be more obvious from where I'm getting my focus. So these three are the ones that I'm going to be focusing on, and as I'm focusing on, I'm going to be considering placing the option trade on it. And of course, with options, we always have a number of options. So one of the things that I like to do after I double click on VST is to look at the chart. So this is the chart of the VST, and taking into account how negative everything is out there, how bearish environment is, and how we have what I like to call the sea of the redness. So I'm bringing again the FinViz here so you can see this would be the area that shows the S&P 500. And there's almost virtually nothing, absolutely nothing that is solid green, right? Everything else that you look at here is a sea of red. However, this particular utility is still holding up quite well. It's still creating the higher lows, and it's also having the higher highs. So now it's somewhere in the middle. So I'm considering placing a trade on it. And one of the ways for me to look at that is to consider maybe this level right below this green unfilled order as a possible entry for a long trade. And long can be with bull put spreads, or it can be done with let's say with bull call spread. However, this analysis need to be proven on the option chain by me locating the footprints of the institutions. So what I'm going to do next, I'm going to focus now on the VST option chain, and I'm going to go far out to perhaps October. And I'm going to be looking at October the 22. I'm going to be looking at the October. Okay, I need to make sure that I type in the correct ticker. This is incorrect ticker. The one that we want to look at is a VST, and this was a utility sector that was still in. So I have changed the ticker here to the VST. And what I need to do now, I need to change this multiple expiration to the October expiration, because that's the one that I want to look at. And I'm going to get rid of everything else. And my focus is at 22 on the put side. And one of the things that I always look at, and I have shared this previously, is volume and open interest. Now, of course, volume is activity just currently what the market is doing. So currently market has been open for not even 2 hours, so I shouldn't expect too much of the activity of the 22 put. So what I'm looking right here is a 22, and I'm looking here on the put side because I want to look at what is the open interest on the puts. And when you look at right here, the activity of the put is 5,096 contracts traded. And why would that be the case? Well, simply that would be the case because the area right here is very solid support on a demand zone. So if the price comes down to that level, a lot of institutions are willing to put online $2,200, sell that put, and obtain the physical underlying at that level. So what I'm going to do now, I'm going to type in Thinkorswim same ticker. Usually at my entry, I placed one single share long just to have a memory of where the price is. So this is a one single share I'm buying at $25.29. It's just placed in $25.29. So buying power effect over here is basically half of that, only $12. There's really no commission for it. And it's just for me a reminder where I got filled. So I have placed that in. And obviously I didn't get filled because I have a limit order and now has already moved to different levels. So I'm going to just quickly change this to the market order so I can hear that ding. So now I'm placing this buying power effect 0 because the commission 0 because I don't have. Okay, so I got filled on that. So now let's re-verify that October 22 put has that kind of activity. So there it is. This is what I was showing you on the top, Trade Option Planner, that we had a huge activity right here on a 22 put, 5,096 contracts, and that supports that level. So if I'm teaching selling of the one single short put, that's then obligation to buy. So I'm clicking right here, sell single, and it's going to say you're selling one contract of the 22 put for $1.10. When I click here confirm, it's going to say out of the $2,200, they're subtracting $110 of the credit and then giving it to me. So I'm now sending this in, see if I can get filled for a 110. Now I have gotten filled. So math behind it is very clear. Now I want to make sure that I finance this particular trade with a bear call spread. And the reason why I'm saying a bear call spread, because now I'm looking at the option chain one more time, and I want to see on the option chain what can I find on a call side for that same expiration. So I'm going back to October. I'm unchecking all these other months, and I'm considering the activity that is guiding me, if other institutions are having same kind of thinking as I am. So I'm looking right here of the 27 and the 29 open interest, and there's something that is just poking my eyes. And what is poking my eyes is simply that we have a 4 digits right here, and we have a 4 digits right here. Could that be a bear call spread? Selling the 27 and buying the 29 as a protection, risking about the $200 to receive whatever that credit is, $1.60 minus $1.15. So that would be about the 45 cents of the premium that they are getting on an investment that is about the $200. Now, of course, when I come up with something like this, I would like to take a snapshot of that and have that in my notes later on when I present this to you. So there's a track of what we are doing here. So I'm placing the trade on this particular ticker, which is a VST. I have gotten filled at the $25.29 a few minutes ago with a single share. And now that I know that I have sold a put, October put, specifically 22 put, which is obligation to buy at 22, but because we need to multiply this by 100, right? How much would that be tying up? $2,200, right? But I have received a credit of $10 or the $110. That thing was reduced. Now still quite a bit of chunk of change that is being placed on this trade. And when you look at right here, here it is. It shows that I have a buying power effect that I need to deal with. By the way, I had the QID open in one of the previous trades, and I want to just show you how QID is doing good when the market is going down. For instance, this QID trade that I did with you in one of the previous session, it's an inverse. I bought it for $24.69, and right now it's trading for $26.56. So that right there, it's about the $200 in a profit. How do we close this? We simply click closing order, sell the 100, right? Because we bought it at the lower price. Now we're selling at the higher price. I'm looking here at the FinViz, what the price action is doing. Currently, it's a little bit bouncing. So reason why I want to exit this, because obviously if the bears had the more strength to push it lower, we wouldn't have this bounce, but this bounce is taking place because the gap on Dow Jones has been filled, gap from previous few days. So it makes sense for me simply just to close this trade right now for a nice profit of about $200. So when I click this, it will show that I have exited that particular trade. And over here, it's gonna just show that, okay, I was wrong. I said the $200, but it's basically $166 on that particular trade. Okay, going back to what we need to do, and what we need to do is place the trade over here on October that involves the 27 call and the 29 call. So I'm gonna go over here. I'm gonna select the bearish, and I'm gonna select the bear call. I'm gonna alter the spread to October, and I'm gonna just type in the numbers. I know that the 29 is what we consider buying, and we can't sell unless we first buy. But what we really want to sell is this particular unit down here, which is 27. So I'm trading 27 and a 29. So I'm buying to open 29 call, selling to open 27 call. And when I click OK, this actually calculates that I could possibly get 60 cents. So let me just take a snapshot of that because the print is kind of small and it's better for us to take a snapshot of that, put it in a Word document, and then slowly walk that trade through, explaining it piece by piece how this whole thing works. So we have here explanation of us selecting the 27 call, selling at the ask, 29 call, buying at selling at the bid and buying at the ask, which produces this particular setup. So sell 27. This is that $1.60 when I initially snapped it. Now it's already $1.68. Of course, the market is alive, so this is dancing. Buying to open 29 call. At the time when I snapped it was 115. By the time I fill it, it's 107. Over here, we were calculating that we are getting about 45 cents. How do we get 45 cents? 115 subtracted from 160 is 45 cents. Now the numbers are a little bit different. I'm actually able to get 60. Now, be aware of it when I click on the Thinkorswim platform and I go to execute this. It might be a different number because from the time I got filled till now, the numbers are at a different level. So here's my position for the first trade that I put in. And here is my 27 and a 29, what I'm going to do. So I single right click. I go ahead here and sell vertical. I make this not in a $1 wide. This is 27.28. I'm going to make it in a $2 wide, which is a 27 and a 29. I'm getting the 60 cents credit, which is pretty much what we had there on the top platform spelling out to us. I go confirm it. So I'm no longer risking $200. I'm only risking about the 200 minus 60, 140. Let's see if they're going to fill me in on that. So I have sent it in. It's working order right here. I'm going to wait a little bit. And in the meantime, what I can do, I can, on a TradeActive platform, copy this into the risk graph. And when I copy this in the risk graph, right here in this area, it's showing to me what the outcome of this trade is once when we get filled. So the outcome of this trade is, let me just take a print screen of that. So I want to make sure that I print screen. One second. It's not doing it. I'll do it one more time. Print screen. Enter. Got it. And put it in. So I'm still waiting for that order to get filled. And sometimes trading the market being impatient doesn't pay off. It's better if we are patient. Okay, now it's changed to the 57.50, which is not quite what I like. I'm gonna make sure that it says a 60 because this is what we originally had there, but it still says a 57.50. Anyway, maybe that's the price that I'm gonna get filled at. So I'm gonna drop it down. Well, there's no in-between prices, so I can get either at the 55 or I can get at 66. So let's just see if they're going to fill me at the 55. Okay, they fill me on the 55. So now that I know on which price level I got filled, and I'm going to type in the ticker here. So we're trading the VST. Okay, so we're trading the VST. The traded price hasn't moved much. Right now, it's at the 25.28. I got filled at 25.29. This is perfect for me teaching this right now. Mark, I will do the 2 bear call spreads in a moment, but I need to first find where the price is for the one. I can always add additional, but that's exactly where I'm heading with that. Ahmed, good to see you. We're trading right now the VST, which is one of the utility. And reason why we picked the utility, because from everything that we looked at in the groups, utility is actually strongest sector in a weak market. And Peter Lynch usually says you should buy when there's blood on the street. When everything is down, when everything is red, that's actually perfect buying opportunity. And over here, as you can see, since we got in, this thing has moved penny in our direction. So we're basically bullish on the utilities because even when everything goes down, people still pay their electricity bill. They still pay their water bill. They still pay this. So it's almost like what we like to call the flight to safety. You know, gold used to be the flight to safety, and now it's a different environment we are living in. So that's why I'm doing this particular trade. Now that I filled on that, I can add one more contract to it, right? So I got filled for 55. I'm going to take a snapshot of that. So it's very important for me to know where the price is on that in the future. So when I have that information, and I can then put that in the thing and know exactly what I'm doing in the terms of the trade. So so I'm adding one more, create a duplicate order for a 55. And what is that going to do to me? It's actually going to increase my outlay of the capital. So right now, if you're looking right here, VST has tied up this much because we have a put that we sold, but now this is going to increase when I place one more order. So I'm placing the one more order on this one for 55 cents, confirming it, sending it in. I got filled at 55, and now the maintenance that I have has actually gone up by additional about $200, right? So just be aware of it, that this is a way how this thing is being traded in the terms of the bear call spread. So now my bear call spread is receiving the credit that is basically financing some of the cost of my short put. So my short put is costing me close to $2,200, but because I'm bringing here $55, an additional $55, that's like $110. I have now received a total of the $110 plus this $110. That's a $220. So I reduce the outlay of my capital from originally 2,200 to about the $720. That's the whole logic of me doing this particular trade. So I just want to record here what did I got filled on a 27 call. I have got filled for $1.65, and on my 29 call I got filled for $1.10. So when I go here to Trade and I look at these numbers, I can actually edit the spread with the exact price that I got filled. So my filled price for the 27 was $1.65. My filled price for the higher one was $1.10. Now that I have this and I click OK, now this section is actually accurate, and I'm saying the reason why it's accurate because we got the correct pricing of it, correct pricing according to what we actually got filled. So we got filled here, and we know that I'm risking $145 to earn $55. So recap, right? So I sold this put. I was risking $210, $2,200, but I have gotten credit of the 110. I've gotten credit of the 110. So one more time. This was the one that I sold. So when I go over here, create a duplicate order, confirm it, you would see that my maximum loss due to the fact that $110 gets subtracted from 2,200, that my maximum loss was $2,090. So knowing that this equal capital outlay of $2,090, I was trying to finance that the short put by selling two bear call spreads. And these two bear call spreads that I sold is the 27 and the 29. So if you can kind of picture this from the top to the bottom, and I'm really trying to work this mathematically so you would understand that it's all about visualizing what we are doing with the trade. So currently we are trading at let's say 25.30, just for the simplicity's sake, right? So the 26 is above us, and then right above us is 27. And the reason why I say it's 27 because the strike price 27 call is out of the money, and I was able to sell that for $1.65. Now, sadly, I couldn't keep all $165 because in that case I wouldn't have a protection. So what did I do? I skipped the 28 strike price, and I have bought higher strike price. So I bought to open the strike price, which is the 28 call, okay? Which is also what I like to call out of the money. So that's also out of the money. Now, because that's further out of the money, I ended up actually $1.10, right? I actually ended up paying. So I was paying for this $1.10. And over here, this is the one that I sold to open. I sold to open this strike price 27, and I got the credit. So when you subtract this thing, then you get this 55. And I did this twice. So that's mean two bear call spreads, like Mark has suggested, has brought me in basically 55 times 2 have brought me in additional $110, right? So now I have received $220 on this particular trade, which has knocked down about quite a bit from my initial outlay of the capital. As I have pointed out to you right now, what do they want? What does the broker want from me in terms of the margin? $720, which is definitely less than the $2,900 that we $2,090 that we originally had. Now, be aware of it. I still have a one more trade on, but it's not on a call side. It's actually on the put side. So on the put side, what do I have? Well, like if I number this is a 26, 27, 25, 24. I'm going to add a few of these lines so you can kind of follow it, right? So if this is 24, 25 right here, then we go down here 24, and then we go down here, it's 23. And this is the one that I sold to open October 22 put for a credit of the $1.10 or $110. Now, obviously, this put is out of the money. Out of the money. So this put is out of the money, and I have a here example of using what I like to call intrinsic value. So instead of volume, I'm going to switch this to the intrinsic value, and I'm going to show you that these are the out of the money calls, right? So when you're looking right here, $25 plus this 34 cents equals the current price where we are, and we are currently at 25.34. But when you're going down to the 22 on a put side, all of the things below 25, all of the things below 25 is actually also out of the money. So here's a line in the sand right here, and notice these are all out of the money. So I went down 4 steps out of the money to sell this, and the reason why I did that, if you remember at the beginning of the discussion, is because the institution is there. And why did I pick the October? Well, let's see. If I just focus on the 22, how many choices do I have? Well, I have a September, and I see there's quite a bit of activity over here too, but they're different levels. Well, I didn't like those levels. I like the levels that were plotted for me by the chart. So on a chart, 22 level is right below these green unfilled orders, and I felt comfortable with it. So I'm going to stop right now, give you a chance to type in a few questions about it. And if you don't have questions, I would like to look at another example and another example and another example till this procedure that I'm doing starts to make sense to you. I highly suggest you watch this more than once, so you kind of follow the logic that we did, right? So how do we find this trade and how do we arrive at it? So I'm giving you just a couple of minutes to type in the comments and to understand that I'm financing one trade with another trade. That's the whole thing. So I'm bullish on this trade, and the reason why I'm bullish on it because it's a utility sector, and utility sector is currently looking good in comparison how everything else is bad. So one more time over here, when we looked at it, I said these are the three examples of trades that are looking good. So obviously VST was the first one. We can now look at the VEC, and if you have a time, we can look at that. So at the XLE. Now, be aware of it at XEL. If the liquidity is not there, we're not going to do it. We're not going to do it. So from all of them, when I looked it up, the first one was the cheapest one in terms of the price. So VSD was costing $25. If I now move on to the next one and you don't have anything else, be aware of it. This is about 4 times as expensive, 4 times as expensive. And actually is kind of in between these two, right? So I'm reading the comments. Mark says, makes a lot of sense to me, Jeff. How do we exit this trade? Okay, first of all, this trade goes out till October. So the more time it passes, it's better for us. And the reason why I'm saying this, that it's better for us, because what is our end goal of this particular trade? Our end goal is that the price that is right now at 25.30, okay, stays either at the 25 or even goes to 26. Either of these choices for me is completely fine. Either of these choices is completely fine. So I really, I like to trade when I have a very low expectation of the physical underlying. And when I have a very low expectation of physical underlying, it's like, well, how do you make money? Well, I'm making money that I said I'm willing to take obligation to have the stock put to me through the sold put, which is a double negative, which is actually bullish trade. But I'm not going to pay you $25.30 for a current price. I'm willing to give you only $22 per share. And not only that, I actually asked the market maker to pay me. And the market maker ended up paying me, Jeff, right here, $110. Now, of course, this is $1.10 times 100 because we sold 100 shares. So my capital outlay for something that's supposed to be $2,530 is $2,090. So I'm really bargaining. It's almost like you're buying a real estate, and a realtor has listed as a selling agent of that particular a person who sells a house at the higher level, and you're coming in as a buyer and you're giving the low ball offer. And you got actually paid because you're tying up the capital all the way October for that. That's the way how you make money on that particular trade. Now let's talk about the bear call spread. This is a call side right here. So we sold to open. We sold to open. Right here, I'm going to make this in a red. So you are kind of aware of it, that that's obligation. Every time when you sell, you have obligation. Well, how can you have obligation? You still didn't even get the stock. That's why we went ahead first and we bought this particular call for $1.10. That gave us the right to buy. But do I really want to buy something that is out of the money? No, I mean, it's like this thing is so far out of the money that it almost makes no sense to do it. Well, then tell me, why did you do it? I did that for a simple reason, that 3,215 contracts have been traded by the institution for the same reason that I did, so they can turn around and sell this one. Well, Josip, why is this not 3,215? What about if some of them are more aggressive and they're willing to sell it at 26? Could it be that they're selling at the 26, 800 of the contracts, and here at the 27, rest of the 2,600? Either of them can make a bear call spread as long as they have a one unit that we like to call auxiliary unit versus a one unit that is commanding unit. My commanding unit is one that is costlier than another. So my commanding unit is this one, 165, that gives me a credit. Now, of course, of that credit, do I need to give them back $1.10? Yes, I do. And that's why my total credit is a 55. And then I took a suggestion from a Mark and I just did the two of these and I was able to take in additional $110. So $110 from a put, two times this, $110. This is $220. I reduced my outlay of the capital. And I'm now ready to look at the next candidate. Next candidate, if I go up here, is VEC. Now, this VEC candidate, if there's no liquidity, I'm not going to do it. But if there's a liquidity, I'm going to jump in it. And what was one of the things that we figured out if there was a liquidity? Well, first, we pull up the option chain. We type in the ticker. And from all the things that we have ability to look at, we really should be looking at volume. And it almost doesn't matter if you're looking at the volume of the calls or the volume of the puts, because if there is activity of the open interest, there's supposed to be activity on all of them. And what's the one thing that is poking your eyes? Single digits, two digits, three digits. Do you have a lot of activity on a call side? No. How about over here on the put side? Pathetic. So I suggest rather than us wasting more time on trying to find a trade in which the institutions are not in, perhaps I could just move on to the XEL, which is an energy. Now be aware of it when I pull this up, I want to look at the chart. And then I'm going to actually see if I like the level that is matching with the institutions. So XEL is a ticker. So I'm not going to look at the option chain. I'm going to first look at the chart. Okay, so I can look at the weekly to make sure that on a weekly it's in an uptrend. Well, we have technically speaking, an uptrend because we have a low and we have a higher low and another higher low and another higher low. So in this case, if somebody says to me, at which level would you like to acquire it? Honestly, I would like to be super conservative. I would like to pick something like 60. Well, maybe you can pick something here. Yeah, I could, but I would feel way more comfortable if I'm somewhere down at 60. So anyway, I have two possibilities, maybe 62.50 or a 60. So those are the two numbers that I visually see that I like. And another thing that I want to point out to you, this is called in technical analysis term ascending triangle. And what is usually happening with this ascending triangle, that when they break up, they are able to travel this distance that you have right here of the base of the triangle. So this thing goes from a 47 to 74. You can project that much in amount of time from April till April within a year, right? So what I think that I'm going to do based on this time, I'm going to start looking at the December, and I'm going to see in the December if we have liquidity on a 60 puts or maybe 62.50. Although personally I would prefer the 60 more. So I'm looking up here option chain. It filled up the correct ticker, so I'm not being misguided like earlier when I pulled it up and it had the XLU ticker, because everything that we do it's in a utility sector. I'm going over here where it says choices. Well, it's not very liquid in the terms of the expiration. Obviously, we don't have a weekly options, but it doesn't matter. When you're buying a house, or when you're selling a house, you don't care how many people say it's too expensive. You just need to get the one who's willing to buy it at your level. So now I know I want a December due to the fact how that chart was looking, and I want to give myself time. And the place that I want to look at, it's on the put side, and I want to look at the 60 put. So look at it. Is there something that might be quite different from what we have seen before? Before, when we were looking at open interest, and we couldn't find 4 digits. Over here, we have activity of the 3 digits. That's the biggest activity. But I'm not on a call side, so it doesn't concern me. What really concerns me, it's a put side, and there's something that is smiling at me all the way across the room. And what is smiling across me, it's the 4 digits of the 60 put. This 4 digits of the 60 put is all that I need. It doesn't matter what this thing is at 62.50. In fact, there's no even 62.50. Look at the strike prices that they have. They have a 60 strike price and they have a 65. And I was looking at the chart and I was saying, well, I like 60 over the 62.50, but if they don't have 62.50, that's it. This is my choice. So I know with options, we have options, but I just need the one right choice. And the one right choice that I need is actually right here. So I'm taking the snapshots right here. So you can actually keep that so I'm now doing the VEC. So we have did the VST. So now I'm doing the, not the VEC, this is a XEL trade, which is, what is that, about $74 stock. That's right. And I have found that December, and this is expiration on the 16th, that's the third Friday of that month, 60 put is giving me on the bid, well, coincidentally, $1.10. I don't know why it's today everything $1.10. So let's see if we can do that. So now I go to the platform. I type in VEC. I pull up the October. By the way, it's always good to have a two platforms so you can verify on the two platforms if the data that you're getting is still correct. Actually, I'm not in October, I'm in December because I wanted to have more time. Actually, that's not even the right ticker. XEL is the ticker that we are looking at for December. For December, that's right. And we had 1,212, so 1212, and it's a 110. So when I click this, it's gonna ask me for $6,000. So take a look here. This is where you should start reading here. Maximum loss. Maximum loss, $6,000 minus that 110. They wanna take up this much. So be aware of it when I click this send with the one single contract, that would virtually tie up about the $6,000 of my account. So we would need to consider the financing it. So I have sent it in. I got price improvement at 115, which is always a beautiful thing when it happens. And they have gone ahead and took this much money from me because this is an account that has quite a bit of money. But that's not the reality on the smaller accounts. They would want an entire 6,000 minus that. So now I need to go back and consider I got filled at the 115, but risking basically 6K. Okay, I'm risking here 6K, and I hope you're all clear where I got the 6K. It's all about the strike prices. It's all about the strike prices, and this is almost like how should I call this? Let's say certificate of deposit. You went to the bank, You put in the $6,000 in, and at the end of it, in December, you get back your $6,000, plus you get this $115 of quote unquote interest. If the price stays below what? If the price stays below that 60 level. And as of now, we are up there at 74.85. So what needs to happen? My friends, let me tell you, nothing. Nothing needs to happen. If the price goes up, you're still risking $6,000. So nobody's going to come and force you, oh, you need to buy at $60 something that is trading at 74.83. And why we pick this particular utility? Because, as I said, I looked at the weekly. It looks good. I can look at the daily. It has these UFOs. So for me to be wrong, it would need to take out all of these UFOs and then go even lower down to this level of 60. So this is what I like to call super uber conservative trade. But let's look at the financing. I want to see if I can mimic this trade to be similar to the trade that we did earlier. And the trade that we did earlier, I'm going to just repeat it to you, was this VST, right? So with the VST trade, I have sold the put, and then I turn around and I look at the financing. And I was able to do the financing because we had a lot of activity. Well, I haven't checked that yet. So I need to check that on the platform and see how we are doing with the liquidity. I mean, maybe there's no liquidity there. Maybe there's absolutely no liquidity there. So let me now just bring back again option chain for the ticker that we are dealing with, which is XLE, for a specific expiration, that is December. So all these other ones are irrelevant to me. It's like picking a dictionary, and you're not going to read the dictionary from a beginning to the end. You just want to flip in a dictionary to exactly what you need. So we were here on a put side earlier, and we are observing that the put had a lot of activity right here at the 60. Well, now we need to move on to the call side, and we need to see on the call side open interest. And what am I seeing? Not much activity. Not much activity. How about if I look at the different cycle? Maybe on a different cycle, I'm going to see something else. Or could I do different cycle? Well, you could do different cycle because the whole lesson is called option with options. And look at this. Am I seeing something quite interesting at this particular level? Well, I do. I see the 4 digits. And what is the strike price? 85. Now, I need to be aware of it, that if you're currently at 75, or whatever that number is, 74 and some change, this is a 10 points higher. So it could be institutions are anticipating this to lift, but not to rally above the 85. Well, the next thing I need to see, how much money would I be getting? Pathetic 45 cents. And don't forget, out of that 45 cents, I would need to get something higher to finance. And look, for you to finance that 45 cents, you need to give out the what? 50 cents. Math does not make sense. Why? Because this particular 90 call has only 12 contracts traded. Now be aware of it, this is a one data point, and we can now re-verify that data point using alternative platform. So now I'm going to alternative platform, which is a TD Ameritrade. We're looking here and we're observing that this is a very low liquidity. We switched it from December to September. We have located over 1,000 contracts traded at 85. And then look at what the market makers have done with the pricing of this particular underlying. They start jacking up as if they don't want to trade with you. Because for you to sell this, you would need to buy something. And what did they tell you? Oh, you can buy the 90 for $50, but if you want to buy even higher up, 95, this is like going to store. You can only buy for 75, but you can never return it. We can never return it. So I'm sorry, but there is no bear call spread to be done on this particular trade. Well, you didn't check the other one. Okay, I can check the other one here just quickly because we're almost out of time here, and I want to summarize what we did. And I still see that that doesn't inspire confidence at all. Again, I have a 4 digits here, and over here it's only 3 digits. Done. Let me recap. We have a 5 minutes before the session ends. I'm going to walk you through what was the logic. So, I'm sorry, today is the 24th, it's not the 20th. 20th was when I did the last session. So, I went over the big picture. I saw that the market was down. And while we were talking, actually, market is surprising everybody. Look at this rip to the upside. I personally knew that this is most likely going to happen. And reason why I said to you, because when you look at the diamonds, DIA, you would see on the diamonds there was a big gap between these two sessions. This session right here and this session was a gap. In order for market to go higher, normally it comes down, fills the gap, but it doesn't go any lower than a gap. And then it has a rip your face rally in opposite direction. And then there's a short covering because everybody who was shorting it, how do you think they feel right now? Like when this thing is ripping to the upside. Look, we started a session, Dow Jones was down $450. Now it's down only 200 and something. This is a $200 move against the bearish traders who are probably like bleeding and cursing and doing all sorts of things. So we looked at the big pictures. We jumped into sectors one more time. My personal opinion, Tradeactive Option Planner has a lot of tabs in. The most underutilized tab is groups because people click on it and they don't realize that the magic happens only when you actually click right here on the long trend. Because when you click on the long trend, you're no longer looking only on the last 10 days activity. Because over the 10 days, that's really, market can have a bad 10 days, but it can have a fantastic year. So 10 days mean nothing. So you need to click the long term and then confirm it. Yeah, basic materials is having a bad day. Consumer goods, blah blah blah. Then you're looking at the oil sector, but we already beat up the oil sector in the last session. I want to just show it to you. Even in the down environment, 2 trades that we placed on the 20th, NRG. Even on the down day when we're losing $15, I'm still up $50 on it. Okay, but I'm not going to be touching that trade now, nor I'm going to be discussing it. Volera, okay, right now Volera has a little bit of the loss of the $22, right? But earlier in the day it was up. But these are the longer term trades, and because they are on the oil, I'm going to just keep them open, right? So today I wasn't looking at the oil sector. I was actually looking at the what? Basic utilities. And then when I double click on it, on a basic utility, it broke it down into subgroups. And if you really pay close attention to it, you will notice that it has 3 subgroups and they're colored in gray. Electric one, multi-utilities, that would include the solar and all sorts of things. And then you have a water utilities. Now, I didn't waste the time on the water utilities for a simple reason that it's a red and red, and I want to have at least one of them in blue. And then once when I got in blue, I have gotten the individual names. So when you look at right here, it breaks down what you're looking at. And I'm going to just change the color here, maybe in a green, so it will become a little bit more clear. So I'm looking here at the US market, specifically US market utilities. And within the utilities, I'm looking at the electric utilities. So what did I do next? I actually decided to find the ones that are best performing. And the ones that were best performing were these 3 at the very bottom of it. These 3 at the very bottom of it, if you scroll it down, they're easy to analyze. They're right next to each other. Now, what you can do, you can start looking at the top part and trying to understand what is going on. When you have a dotted line like this is just like a sideways move, sideways move, sideways move, right? I mean, of course, this would look way better, but maybe for a next session, I'm doing the next session, whatever that is, I need to check my calendar, then you can look at that, right? But in this case, I want to get into something that has a potential, to break to the upside. So then what did we do next? We selected the VST. VST was a $25 stock. I fired the trade in at 25.29. Oh, you know what? We placed the trade at the XEL and I didn't fire the single trade on it just to know where the shares are. $75. Because I'm going to just buy it so it has a footprint of where the price was for me when I traded it. Okay, so now I have a reminder that this was at 75. But on this one, I fired the trade in. I bought a single share. I went long one single share. And then I went ahead and I sold October 20 put. And that put me into debt. And then I was like, well, I don't like to have a $2,000 of the capital. I would like to reduce it. And I was able to reduce it to about 700 and something. And how did I reduce it? I fired first a bear call spread and then Mark type in, hey, why don't you do two? Well, I did two. So I received twice $55. That's $110. And then when I was done, I said, like, let me present to you everything that we did. We started with this. This was my driving trade, the trade that was really main trade that I was trying to finance with this bear call. So having finished that, I said, okay, now I know I threw it lots for you. Let me repeat the steps. So then we looked at the VEC and we just couldn't find the liquidity. Institutions didn't leave the big footprints. I said, forget it. Let's look at the last candidate, XLE. We're able to find open interest. This would be almost like a UFO because what is UFO? Unfilled order. Open interest is order that is open but it hasn't been closed. So you can say to an extent it is some kind of unfilled order because what about if they want to buy this back for 5 cents? Then it's no longer open order, then it's a fill order. That 5 cents that they buy this thing back frees that $6,000 that they can invest something else. So really what we are doing here in conclusion, we are using the unfilled orders, hence UFOs, right? Unfilled order. And we're using also open interest, which is the flip side of that, to come to the conclusion. And once when we fired that trade in, we're trying to finance it with the bear call, and we concluded there was nothing on the bear call. So we're out of time. Once again, you can look up everything that we did right here on our website, tradingwithufos/Josip. I usually upload this, and then you have a chance to go over the trades, and I would highly suggest that you rewatch this more than once. So once again, please stay hedged. Do not trust the market very much. Every time when you do something, you should have two trades. If the one doesn't work out, other one it does. Josip, I don't understand what you just said. How about this? I'm bullish on a trade, but in case it doesn't go up, am I not making money on a bear call spread? So just think about what I taught you today. I taught you a bullish put trade that is being financed with the bear call spread. It would be, like, I don't want to say impossible. All the things are possible, but it would be difficult to be wrong on both of them, right? Because if it goes down, at least this one is making money. If it goes up, at least this one is making money, as long as it doesn't go above 27. So, Jeff, you were asking me, how do we exit this trade? At this point, Jeff, I wouldn't be so much concerned about exiting the trade. I would put the alert at 27 for this particular VST. And only if this alert gets hit, then I would consider doing something about it. So Jeff, if that makes sense, just type in something in the chat box. Otherwise, I think I'm done. Same thing with this beast up here. This beast up here, I would put the alert on a what? 60. And why would I put the alert on a 60? Because we're at where? At 74. When I'm proven wrong, if the price drops to 60. So I would have an alert at 60. So that alert would read at or below. So when the price is less than or equal to 60, then I would need to act out, and I wouldn't necessarily just put my orders in. So Jeff, stay hedged, and I wish you all the best. And I look forward to seeing you. I think it's a sharpening section. I just checked my calendar that I'm doing next. So bye.